We've talked about spotting extreme momentum with the RSI, but what if you want an even faster, more reactive indicator to catch those sudden market moves? That's where the Commodity Channel Index, or the CCI, comes into play. But before we dive deeper, there's something important to understand first. Standard variable. In statistics and data analysis, the term standard variable, or z-score, typically refers to a standardized variable, which is a transformed version of a raw variable that has been adjusted to have a mean of 0 and a standard deviation of 1. We use the standard variable to eliminate differences in scales or units, allowing us to compare the behavior of various objects directly. This technique is especially helpful for algorithms that assume data follows a normal distribution. As mentioned in the Bollinger Bands tutorial, price movements aren't perfectly normally distributed, but they often approximate it closely enough for practical use. The CCI functions similarly to a z-score for past prices. Let's begin exploring how it works. The CCI is a versatile, oscillating indicator designed by Donald Lambert. While it was originally created for commodity traders, it's now widely used across stocks, Forex, and cryptos. It measures the current price level relative to an average price level over a given period. Essentially, it tells you how far the price has deviated from a statistical average. The CCI is calculated by dividing the z-score of prices by 0.015, which means 100 times the z-score with 1.5 times the deviation. It would be better if we had double times of deviation like Bollinger Bands, but this is what we have now. It can be a fast and aggressive indicator. As mentioned earlier, the CCI transforms the price chart into a standardized variable, capturing every price movement within a range of -100 to +100. So it's important to approach its analysis with caution. Here's the CCI with period of 14. Notice how even the smallest fluctuations create significant spikes in the CCI. This is period of 35. Smoother and more meaningful changes of CCI. And here's 50. So, for a sensitive indicator like the CCI, selecting the appropriate period is crucial for reliable results. The CCI forms 3 separate regions. Above +100, between +100 and -100, and below -100. Gray areas show the high probability of trend direction change. Middle area shows the trend strength. If price fluctuations had normal distribution, this probability at plus or minus 100 lines was about 90%. In reality, it's approximately 70% or lower. But when higher values of CCI reach to their maximum or minimum, it signals a convenient trend direction change. Let's analyze this chart with CCI values. It moves around zero line, above and below it, and subsequently crosses above the 100 level. The reversal emerges at CCI 220, signaling the strong beginning of a new downtrend. CCI as a standard variable copies and converts price chart to an oscillator around zero axis. So it is independent of the price level and simply indicates the strength of the trend. So it is an ideal indicator to find divergences, as you see here. Second maximum has a higher price level, but CCI shows that it is lower strength. It signals a trend reversal after the second maximum. CCI isn't widely used, but it reveals many unique patterns if you explore it yourself. As I mentioned, it functions as a z-score of the chart, condensing all price movement behavior into a straightforward oscillator. Dive in and uncover what's yet to be discovered. Hope you enjoyed this breakdown. I've got more trading insights coming your way, so stick around and catch the next episode. It's going to be even better.